Hello and welcome to Indianomics, a special edition because there is trouble with our macros. In fact, double trouble. Let me begin with the first one, the numbers that came out for January inflation. It's been rising steadily for the past 4 months. 7.3 was an ugly number, we thought, for December. One thought it would peak off maybe to 7.25. That's what the CNBC-TV18 poll said. But 7.6 was outside the outside range that we got in our poll. Let's come to the big culprit, food inflation. Again, 14% one thought was one-off because of a bad onion crop. But even after onion prices fell, we are seeing a 13.63, which is almost a 14% food inflation. And adding to onions were a whole host of protein commodities like milk, meat, eggs, fish, pulses. So this is no longer a one crop failure inflation. It's deeper than that. And finally, perhaps more importantly, the core inflation, the non-food, non-fuel inflation that will come up for you. There again, used to stand at 4. We thought we had brought it down, and that climbs again in January to 4.2%, which means a wide range, personal services, transport and communication, a whole host of them are rising. So, services, when services inflation rises, it is important because services can't be imported. Anything else, pulses or milk powder, can be imported. But services are the inherent, durable, enduring inflation of a country. It's not good that it has climbed up by 70 basis points in just 2 months. Now, what is the other trouble? The other trouble was that rising inflation is coming in a syndrome of falling growth. This is the industrial output number which came for the month of December. After several negatives, we got a positive in November. So one thought one had at least seen the last of contraction, and you get a December number, which is again a contraction. Let's pick up just some of the important numbers. Capital goods, I guess everyone knows that capital investment is not happening, but at least the contractions seem to be reducing. It goes up to minus 8.6 in November, and then there is again a huge, almost minus 20% yet again in December. But at least everyone knows that capital expansion is not happening. What about consumer durables? Wasn't there talk that there is a lot of consumer durables consumption that we are seeing? Well, at least the December numbers don't bear that out. Of course, we know about autos, but just about every other consumer durable also appears to be falling, at least as of December. And finally, this is consumer non-durables. Non-durables are what you may call FMCG or personal products, soaps, hair oil, combs. I mean, things which even in a downturn people would continue to consume. But that has contracted. Consumer non-durables, this is serious belt tightening by the consumer. It should make us worry. And hence, at a time of rising inflation, this falling growth is throwing up a lot of very difficult questions. The first question, more perhaps academic, is this stagflation? Economy stagnating, but inflation going. Are we in a stagflation situation? A more pertinent question would be, is this inflation a passing problem or is this an enduring problem? Because your response will be tailored that way. The other questions, the Reserve Bank has been persisting with abundant liquidity and a dovish stance, cutting rates to encourage growth, but can it do so in a context of 7% and 7.5% inflation, which is persisting? And finally, if low interest rates are not the cure, what is the cure for falling growth in a context of rising inflation? So clearly we are in a pickle, and to answer some of these questions, I have with me an elite panel of economists. Joining me now are Dr. Sudipta Mundal, former chairman of the National Statistics Commission, member of the 14th Finance Commission, Soumyakanti Ghosh, the Group Chief Economic Advisor at State Bank of India, and A. Prasanna, the Chief Economist at ICICI Securities Primary Dealer. Gentlemen, thank you very much for joining us. Well, Dr. Mundal, let me first come to you. Is it stagflation? I mean, perhaps that's an academic question, but should we worry now that rising inflation and falling growth is not behind us? It is also ahead of us.
Yeah, I think stagflation would be too strong a word. For us in India, growth rates of 4 to 5% look very low, since we like to grow at something like 7, 8, 9%. but by global standards, it's not such a low growth rate at all.
Okay.
So, of course, there's a deceleration growth, very severe deceleration, and we worry about it. But I think to say we are heading for stagnation may be premature.
Okay.
And on the inflation side also, prices are very seasonal, especially food prices. So you have to de-seasonalize the inflation, the headline inflation rate that you're looking at to know what is actually the underlying inflation trend. I think we are under inflationary pressure now, but too early to press the panic button and say we're heading for stagflation.
Okay. All right. We will not use that academic word,
That
but
would be
I'm
my
not quite
initial
convinced about this inflation being a seasonal issue for the simple reason that it is now spread to something beyond onions. So that question to you, Prasanna, would you say that now this is getting a little more widespread and therefore worrisome? The Food and Agriculture Organization, FAO's food index, is also rising globally. And in India, it is spread way beyond one onion crop. So your thoughts on how persistent can this inflation be?
Well, Lata, I think you are right. I mean, the rise in inflation has been quite broad-based within the food basket. So I think media has been blaming it on onions, but it is not just confined to vegetables. I mean, it is across cereals, pulses, milk, animal protein, and so it's basically been quite broad-based. But the thing we have to remember is, I think for at least 3 years in a row, I think in India we have had weak or benign food prices, both at the wholesale and at the retail level. So some of it is definitely a reaction or a return to normalcy in terms of the terms of trade between the agriculture sector and the rest of the economy. Also, I think some extreme weather events have also kind of come together on the vegetable side, of course, we know. But I think even otherwise, I think the kharif crop, some of it got destroyed, and I'm sure that has also added to the pressure. This is, at least in terms of vegetables, they are short cycle crops. So obviously the response is already happening. Even in onions, the prices have started coming down. But some of the other items like pulses, for example, it is going to be a more enduring problem. Now, cereals is very interesting. Since you're asking that is out of control, the government has food stocks. It can manage to bring it down if it decides to sell. Of course, if they have to sell, maybe FCA will have to sell at a loss. So obviously, these are all political decisions. So I would think that at least in some aspects of food inflation, I think definitely the policymakers do have some control. It is how they choose to exercise it. But the broader point for me is that I think it's a correction in terms of trade, and therefore I don't think from a macro point of view one should be too worried.
Oh, really? I still want to get my other two experts on whether it's not a point of bother or worry. Shaumya, even core inflation has picked up. We have seen transport and communications higher. Some aspects of personal services has also gone up, household goods and services. Now it's creeping into core. So you don't think it's worrisome now?
See, Lata, if you actually just give me 2 minutes, the last 4 months, if you look into the headline data, that has increased by, I think, around 297 basis points, of which 75% is food, fuel, spices and other things, and 25% is core. So there is an element of core in the overall inflation, even though it's on the lower side. For example, and most of the core, if you actually look into that, is because of the mobile and also to some extent clothing. So that's two aspects of the core. The second thing is that even though I will agree with my panelists that we should not worry at this point of time, but one point which I would like to highlight is that for the first time there is a clear convergence of rural, urban and headline CPI. If you actually look into the three numbers, rural is just higher by headline by around 10 basis points and urban is lower by headline by another 10 basis points. So there is remarkable convergence, implying that the food prices are actually the pressures on food items, and also the other items are more broad based. And thirdly, another aspect which I'd like to highlight, apart from Prasanna, which is correctly highlighted on the cereal front, for example, there is rural inflation is running at significantly higher levels than urban inflation, and some of the last 2 to 3 months some of the trends are looking worrisome. For example, I'll give you one trend. LPG prices, the contribution of LPG and firewood and chips, which is basically firewood and chips is an item for consumption in the rural areas. Their contribution to overall inflation in the last 4 months has been 15%. So we don't know yet whether the increase in the LPG prices, which in fact has contributed around 30 basis points to, so around 10% to the overall headline inflation number, whether that is leading to people wanting to use and substitute like firewood and chips. It also had happened 3 years earlier, and the problem is that in these items, if you have the inflation starts, it gets significantly accelerates. So these are some of the things we should look into. The other item in rural area which is creating a significant upside is the spices inflation. If you look into the spices inflation, that has in fact tripled in the last 3 to 4 months, possibly because of the garlic. So I should not call it an item-wise inflation, rather than it has spread to several commodities. But my point is that we need to look out for some more months of data to arrive at a definitive conclusion.
Dr. Mundal, since you've worked in the ADB and you have international experience, I wanted to ask you that the rise in the Food and Agricultural Organization's index, the global food index rising, and plus the tendency of some price wages to go up along with inflation, you don't see these two as making food inflation this time around slightly more difficult than what seems on first sight?
No, I think we should keep an eye on this, as I repeatedly emphasizing. But I'm just saying, let's not get into a panic mode, because that can adversely affect price expectations. That's all I'm saying. We must keep an eye on it when global food prices go up. I remember you were mentioning the last time this happened in a big way. Food riots actually broke out, not in India, but in other parts of the world. And it was a big challenge when global food prices went up. That was quite some time ago.
Yes, 2010.
But so I'm saying we should remain concerned, but not ring alarm bells. That's all really I was saying. And we need to watch what happens over the next few weeks.
Okay. Fair point, sir. I just want to recollect and put on the table that last time around when Indian inflation was in double digits, food inflation, I also remember that meat prices and pork prices in China were rising. This is happening again now. Even at that time, there was loose money policy being followed by all central banks, 2009 and 10. That is happening now as well. So there are several common traits. And at that time, it persisted beyond our wildest dreams and fears. I'm just wondering whether this can happen now. And that's why my persistent questions to all three of you. But now I have to take a break. And
No, I think
I'm coming to you, sir. After the break, I want, my questions will be on the action. One, can the Reserve Bank persist with cheap money policy at a time when inflation is rising? Secondly, even if they persist, will it work when inflation expectations are high? And thirdly, are we endangering financial stability? Those questions to my guests in a minute. Welcome back to Indianomics. We are discussing the double trouble that the Indian macros are facing. Inflation is rising and at the moment at 7.6%, the last reading for January, and industrial growth is contracting. The last number for December coming in at minus 0.3. I've been speaking with three important economists, Sudipto Mundal, Soumya Kanti Ghosh and A. Prasanna. Gentlemen, thank you for your patience. Dr. Mundal, okay, let me start with the banker first. Prasanna, at a time when inflation is rising, should the RBI persist with its effort to bring down the yield curve, to bring down the term premium? Is that a contradictory signal to send?
Well, I think RBI's own forecast is that inflation will come down. So, obviously their actions, I would assume, are predicated on that forecast. And also, if you look at what they're trying to do, I think it is the past rate cuts which have not been transmitted by the banking system. And I think you have to understand that the latest round of actions is by and large aimed at the banking system. Of course, the bond markets have also rallied. But the idea is to try and bring down the lending rates So I think what they're trying to do is just to complement their earlier rate cuts and try and improve transmission in the banking system. And I think the governor also made this point, I think. So if they definitely have a forecast that inflation will come down, now of course the MPC is not able to act on rates because it has already reduced rates by so much, and it wants to be cautious now. But from a transmission point of view, I think RBI feels that since it does have that confidence that inflation will come down later in the year, it can take these additional steps.
Okay, but now their 6.5% inflation forecast for Jan, Feb, March may have to be revised higher, you think?
It will have to be revised higher. So I think this has been a persistent problem with the RBI's forecast from last year itself. Of course, at the time when they were cutting rates, I don't think too many people pointed out or were actually bothered also, because everyone thought that rates were quite high and they have to be cut. But consistently, I think over the last year, RBI has been underestimating inflation. I guess previously their model was overestimating and they've done some correction, but now it's on the other side. So I think this year also probably now they will have to revise up their inflation forecast. Our sense is that in the second half of fiscal also, inflation might at best converge back to 4%. It won't go below 4%.
Okay, so the forecast of 3.2 and 3.8 not happening. But Soumya, how can a banker react? I mean, you think of a pensioner, think of any depositor. When inflation is running at 7% and food inflation is running at 14%, can you really cut deposit rates? I mean, won't transmission get jacked anyway?
No, yes, I think... I think before that, I just want to add to Prashanna's point. I think the RBI forecast of 6.5% for this quarter and next quarter is at 5.4%. So our estimates are 50 to 100 basis points higher than that. So based on that, I think inflation will have to be estimated upwards later. But coming to a specific question on the cut of depositors, I think yes, it's a difficult part because as of now, and inflation numbers is unlikely to subside significantly to below 7% for the next 2 months, and next 6 months it will continue to remain elevated. So that's why the RBI is trying to do these unconventional steps so that basically the banks can have the option of trying to bring down the cost of funds without having taking recourse to cutting the deposit rates. And also the fact that if you look into the small savings number, it's at 2.95 lakh crores is the gross collection, which is 25% of the incremental bank deposits last year. So that's not a small number. So I think materialistically speaking, it will be very difficult for the government to cut small saving rates because at a point of time when you are trying to influence the bond market through unconventional policies, I think this could be also one of the ways which the government would like to influence the yield. So my sense is that it will be difficult to cut rates and the RBI increasingly will take unconventional steps to control the entire yield curve structure within the system.
Okay, no, I mean politically I think it would be very difficult for a government faced with 14% food inflation in a country where the CPI is actually 50% food. To cut interest rates. Well, I don't know if I'll have time to come back to that issue again to Prasanna, but Dr. Mundal, the larger question I have, and in fact the most important question is, we have terrible macros now. Our fiscal deficit has gone for a toss and inflation is very high. The only consolation is crude is low and therefore current account deficit is completely under control. At a time like this, if the Reserve Bank were to go on with this kind of sloshing of liquidity in the system, are we opening the gate to some kind of financial instability? Are we vulnerable to an external attack if something goes awry in the global markets?
Yeah, actually the RBI is caught in a bind because, as you know, we follow this rule of thumb, the so-called Taylor rule, and sometimes when inflation is too low or your growth is too low, you say that you should raise rates. When they are both too high, you lower rates and so on. But in this case, these two components are pulling in opposite directions, The rising inflation suggests that you should raise rates. The fact that growth is still very low and the latest IIP figures which suggest that you lower rates. So the RBI does have a problem and that is why I think they have paused. But I think now things are tilting in favor of giving greater importance to inflation. And after all, if as you know, in terms of their memorandum with the government, the main response is actually not growth, it is inflation. And they have to address the inflation issue first. And whatever their models are telling them is to overestimate inflation or they're underestimating. But I think they're going to be more or less compelled to take the inflation issue seriously, and possibly they might again think about ending the pause and raising rates.
Okay, all right. Now that's Prasanna. Anywhere in your horizon, are you seeing a change in stance for the Reserve Bank in a policy or two?
I think before that, there could be one other issue for RBI. I mean, in our forecast, actually, for 9 or 10 consecutive months, we see inflation above 6%, which means as per the RBI Act, actually, they will have to send a report to the government explaining why it is so and what remedial actions they're taking.
Yes.
Now, of course, obviously, these are slightly far-out forecasts are subject to bands of confidence, but this is definitely within the realms of probability. Now, if something like this comes up, definitely, I think, like Dr. Mundal was also saying, I think the MPC will have to take it more seriously. And therefore, yes, I think both the stance and forward guidance, I do think that there is a possibility they can get tweaked. Now, the issue for RBI, I think, is, or the MPC, is that the growth concerns are still very much relevant. I think this quarter, again, growth, the momentum is actually quite weak to start off with whatever data we got for January. That was before the coronavirus impact. Now, when you add that supply hit to that, I think this quarter, again, growth is going to be a write-off, and probably the economy will enter next quarter with a very weak momentum. So therefore, I don't think RBI or the MPC can quickly tilt from accommodative to a tightening stance. Probably they can go towards a neutral kind of a stance, but I still think growth will have to gain precedence at this point of time. And I think both the RBI and MPC are cognizant of that.
No, I take your point that growth is going to be weak also because the transfers to states is cut rather seriously by over 1 trillion. Your own report, Prasanna. So even that can, perhaps create some liquidity choking problems. But quickly, I want to ask the same question that I asked Mundal to both you and Soumya. Just 30 seconds. I'm sorry, I'm out of time. Do you think we are opening ourselves to some kinds of financial attack problems at a time when two macros, fiscal deficit gap widening and high inflation, only current account deficit is behaving itself? Are we slightly more vulnerable, Prasanna?
I mean, it completely depends on external factors. I think right now, externally, it's an environment of slightly weaker growth because of what is happening in China, and therefore global central banks are continuing to keep the policy stance dovish. And therefore, in this kind of scenario, I don't expect any external vulnerability to surface.
Okay, that's good to hear. Soumya, should we worry about financial instability?
No, as of now, I think the global vulnerabilities actually has increased in the last 1 month or so. In fact, the outlook, which was somehow pragmatic at 1 month back, now it has actually tilted to the negative side. So from that point of view, I think, given the global uncertainties, it will be difficult for any kind of financial vulnerability as of now. So, but we should keep a close watch on the external factors, which is likely to impinge more in the coming days.
All right. Gentlemen, completely out of time. Thank you very much, Dr. Mundal, Soumya Ghosh, and D. Prasanna. Well, key takeaways, our experts are not still terribly worried that there could be a financial instability issue with two of the key macros, inflation and fiscal deficit, going awry. But clearly they are worried that the number of tools that the government and RBI have to kickstart growth are becoming fewer and less effective. We wrap up on this edition of Indianomics. Thanks for watching.
At IIM